Okay.
His.
All right. Good morning, everybody. So as Jennifer was saying, yes, I realized that things are changing so fast that I forgot to put in a couple of blurbs in this on the legislation that just passed March 11th, so a couple of days ago. Not a lot of exciting things, I think, from the perspective of my practice, but I will cover some of those initially. But primarily what we're looking at here is, and I kiddingly put the title Biden's Tax Musings, because that's really all these are at this point. I mean, this presentation is a lot about what I think, given my 40 years of experience, is likely to happen, as well as indications of what Biden is talking about, primarily from his campaign rhetoric. So again, there's no particular bills pending right now. Nothing has come out definitively, but except for this March 11th legislation. But other than that, I think we can, number one, expect that there will be an increase in taxes. We have to pay for this pandemic somehow. It's a bailout. Let's not kid ourselves. And we're either going to pay through this with increase in taxes, or the government's going to print more money. Either way, it's going to be a tax on us, either through increases in taxes or inflation. So let's just get started with what I think is likely to occur. Just quickly an overview here of what we are going to talk about. So if all I did was just talk about what I think Biden's going to do, we'd end this seminar in about 10 minutes. So what I do want to do is then expand on some of those potential changes, and in a sense highlight what are some advantages right now with real estate investment and tax benefits of real estate, owning real estate, and focusing then on ultimately some estate planning issues. Because again, we have an opportunity here to do a lot of planning for our clients, and the time is right. If we miss that, it is likely that our clients will experience some huge increases in taxes, especially around the estate and gift side. So, and then lastly, I'll end with what I think the prediction is for 1031. All right, so real quick, let's just jump into what happened on March 11th. So I just tried to pull out of the interesting things again. One is a stimulus of $1,400. Here we go again. This one's actually per person within a family, including dependents. So it is likely that they will receive this payment the way they did before, either electronically, deposited to their account, mailed check, however it was. But timing, I don't know. But we'll just look for those and hope for receiving those soon. Again, there's a phase out, just like the other. So if incomes of over $150,000, you will not receive a payment. Actually, a phase out between, I think, 150 and 160. So another bailout we're going to have to pay for. Commentary. Unemployment benefits have increased as a result of this new act, or excuse me, have been extended. I shouldn't say they were already increased to, I think it was $300 a week, and it will continue on to extend it to 79 weeks. The interesting thing about this is, with respect to unemployment benefits that were received in 2020. So historically, unemployment benefits have been taxable for federal purposes, not for California or state purposes. But what the new act does is make the first $10,200 of unemployment proceeds tax exempt. And that's per person on a joint return. Yes, you're reading that right, 2020, which means that if you've already filed your tax return for 2020, you're going to have to file an amended return. actually, and don't jump and do that right away. There has been guidance coming from the IRS that says, please hold off on filing your amended return until we provide guidance as to how you should do that. So we don't know if they're going to make you file an amended return. Maybe there'll be expedited processes by which you can do it. Certainly, probably a special place to send it, that type of thing. All right. And then thirdly, there is what's called the expanded child tax credit. And this is a credit that's going to be allowed up to $3,600 per child. It will be, you'll be eligible depending on your income threshold. And this will actually now be a refundable credit for low earning families. Jennifer and I were just chatting before the seminar, and I was lamenting the fact that the IRS is being used so much more for just collecting revenue. I mean, now, so with this particular program, the IRS is actually going to have to administer this program and make these payments. And so to the extent that a low income family that's not filing a tax return, there'll have to be checks that are issued, which quite honestly equivalent to welfare checks. One more burden to put on the IRS. They can't even process tax returns, let alone become a welfare provider. And I just put a little commentary on this slide that, it took 2 years for the IRS to establish the advance payments on the Affordable Care Act. So how do you think they're going to do on this? But anyway, and then one other commentary, because this does phase out for incomes over a certain amount, it does actually provide a disincentive for people to work. But you could make that argument, I suppose, with any, economic assistance program.
Tim, we have a question that came through.
Sure, absolutely.
So the question is, can the 1400 stimulus be based on my 2020 form 1040 rather than 2019?
Yes, that is my understanding is if you've already filed your 2020 return, then yes, it will be based on that. If you haven't filed your 2020 return, then it will be based on 2019. But more information to come out. Like I said, this is just a couple of days old. All right, so let's get to some of the predictions here. Again, this is rhetoric from campaign speech. And it does have its foundations in a lot of a tax policy that many of the administrations have always considered. So I think this is potential low-hanging fruit, if you will. Corporate tax rate, which Trump actually had reduced to 21% back in 2017. Biden is proposing to increase that to 28%. Less than what it was, prior to Biden's change, Trump's change. I think it was marginal rate was 35%. So still lower, but higher than present. The alternative minimum tax, which was actually repealed for corporations, was never repealed for individuals, by the way. That is scheduled to come in, but at very large income amounts. So 15% AMT on $100 million in global book income. Section 199 deduction, that's the QBI deduction. That was actually passed in response to the cut in the corporate rate. So it was to make individual rates or business owners who own businesses outside of corporations, give them an advantage somewhat equivalent to what Trump was giving to corporations. That is likely to phase out. There is a phase out for certain specified service industry businesses, but at this point, it was likely that it could be phased out for everybody at this magic $400,000 threshold. I'll go into a little more detail about this in some of the later slides. Individual tax rates are currently at 37% top marginal federal rate. The proposal is to go back to 39.6, which was the pre-TCGA top rate. Currently, we do get deductions for gifts to charity and casualty and theft losses, as well as home mortgage, and a limitation on state income taxes. But that's basically it. You know, under the current law for itemized deductions, the TCGA had really curtailed a lot of itemized deductions, actually forcing a lot of our clients just to simply use the standard deduction, which is now at 24 something, I think, adjusted for inflation for joint returns. So the proposal here under Biden is likely that these specific items will still be itemized deductions, albeit limited, and the overall benefit of those will be limited to an amount that won't exceed 28% of the benefit. In other words, this is what was commonly referred to as the P's limitation. It has come back in and out over many, many years. California actually has, you know, a similar limitation right now on itemized deductions. So if your gross income gets over a certain amount, you lose the benefit, not all, but some of the benefit of your itemized deductions. So that's likely to occur. Big one here with the state tax exemption, and I'll cover this in later slides, but a huge opportunity to be making gifts with a unified credit amount exceeding $11 million. It's actually $11,700,000 in 2021, scheduled to go back to $5 million in 2026, adjusted for inflation. And Biden has proposed to actually decrease that even further down to 3.5 million, and tax the estate tax liability, increase that to 45% from its present 40%. So again, we'll go into a little more detail when we talk about estate planning. Like-kind exchanges, as we all know, recently, actually with the TCGA, had eliminated the ability to do like-kind exchanges for tangible personal property. They limited it only to real property. Now there is rumblings, and always have been, usually rumblings of completely eliminating 1031 exchange. I have some commentary toward the end of the presentation that talks about why I don't think that's likely to happen, but just simply because of the lobbying effort of the real estate community. Every time this comes up, they make very, very good case for not eliminating 1031 exchange. And they've got the economics to back it up. So we'll talk a little bit about that. And then real quickly, the last two on the slide. So the GILTI tax, the global intangible low taxed income. I'm not a foreign tax person, but I'm often asked of the Trump rules, you know, the Trump law changes back in 2017. Do you think that those are actually made sense? Were they beneficial? And I got to tell you that with respect to this area, this probably made a heck of a lot of sense. We had a lot of US companies that were parking significant amounts of earnings offshore. And what this did was basically now tax those earnings, whether or not they're repatriated. So it was, so that won't change, but what they're going to do is change the rate from 10.5 to 21%. So again, to discourage, you know, US companies from taking all their business offshore just because of the tax consequences. So, and then lastly, capital gains. You know, of course, when it comes to real estate and real estate investment, capital gains is a very key part of calculating your return on that investment, ultimately when you dispose of it. So increasing the capital gains rate would severely affect your internal rate of return on a real estate investment. And it looks like Biden wants to tax individuals with more than $1 million in taxable income, and likely including the capital gain, at the ordinary income tax rate rather than the preferential capital gains rates that we enjoy today. Okay, so jumping into a couple of the more meat of those provisions. As I mentioned, the qualified business income deduction. So that is the deduction that we currently enjoy for business income. It really can be any type of business income. So it can be service income, us as accountants, lawyers, architects, personal service in nature, or it can be operating a trade or business, manufacturing, retail, real estate operation. So, and actually with respect to the latter, when this legislation was coming down, there was a much controversy around whether or not operating a real estate business was actually a trade or business. So, the IRS and Treasury kind of struggle with, what is real estate? I mean, is it a passive activity? It seems like we don't have to do a lot of work. We go to the mailbox, we get the check. Of course, if you ask a true real estate investor, they would say, well, that's not the case. Always got issues regarding tenants and repairs and maintenance and that type of thing. So depending on the term of that lease, it could be, I don't have a lot I have to do, or I got a ton I've got to do. So is it a trade or business? And there was some last minute wranglings that actually made real estate and the leasing of rental real estate as a trade, treated as a trade or business for purposes of this 20% deduction. So I only mention that because since there was such a fight to get it in, there likely might be a lot of support, congressional support, to take it away. Just be mindful of that, and also just be reminded that that is available. There is a safe harbor, IRS safe harbor, that designates whether a real estate trade or business is a trade or business. Again, here's this kind of concept that's not clear. Are we a trade or business, or are we not? Well, the IRS has come out with a safe harbor criteria that says if you meet certain criteria, you will be by default treated, or actually, I think in this case, it's by election, treated as a trade or business for purposes of the QBI. But what's interesting is there's a lot of factors that would not be favorable. For instance, you can't argue that a trade or business, real estate, say commercial and residential combined together, would be a trade or business. Triple net. So they have drawn the line with respect to triple net properties and said that if it's a triple net lease, that won't be treated as a trade or business. Well, again, I've got real estate investment clients who have a portfolio of leases, not only triple net, but gross lease. And if you were to ask them, what is a triple net? There is really no one standard for that. So there could definitely be business activity that would raise you to the level such that would qualify for the QBI. And of course, as I said in the past, safe harbors are always meant to be that. They're just safe harbors. If you can prove facts and circumstances beyond that, and it's a trade or business, then you qualify for the QBI. The next area, and this really hasn't been in the radar of the election musings of Biden, but it is something that over my years of experience, I have seen change dramatically depending on the administration. So the rules regarding depreciation, by the way, that's why I like real estate so much. We have the ability to be able to deduct, an asset that is appreciating in value through cost recovery. And typically what happens is if we get an administration in there that is focused on stimulating the economy, then they will monkey around with the depreciation deductions and accelerate those. I think the logic being that we would encourage purchase of tangible personal property, which would stimulate the economy, and then allowing the deduction for that incentivizes people to do that. That's where the bonus depreciation rules came in. So over the years, we've had the ability not only to accelerate the deduction for tangible personal property, but in some cases, we've actually been able to write it off completely through what's called the bonus depreciation deduction. In 2017, so I think beginning in 2018 with the TCGA, they greatly relaxed these rules as to what qualified for 100% write-off. Now it's always been personal property, but the change in the law allowed not only new to the taxpayer and just new period property to qualify, but it expanded the rules to allow for used property to qualify. So that was a big benefit, and especially in the real estate area where we are acquiring property that is comprised of not only structural, building component, but also non-structural components. So if anybody, out there has heard me speak before about cost segregation and the ability to identify non-structural components of real estate such that you can take a shorter life, that's what I'm referring to as a cost segregation study. So obviously opening up the window for qualified property in 2017 really increased the advantage of cost segregation studies and bonus depreciation. So quickly, probably already said it, but what does a cost segregation study do? So a cost segregation study takes a purchase of real property, either commercial or residential, and identifies components that are non-structural in nature, such that you qualify for a shorter useful life and or bonus depreciation. So I think the best thing I can do at this point is just to give you an example. All right. Well, let's just say I bought a building in effective January 1, 2021, paid $1 million for it, and I allocated a typical 80-20 split. 80% of the purchase price goes to building, 20% goes to land. By the way, land allocation is very subjective. I have seen that allocation ranging anywhere from 15 to 25%. Normally, depends on the property type, and lots of times what you'll do is refer to the county assessor's bill to make that determination. But this is typically the range. All right. If I take that 80%, then I divide it by 39 years. If this is a commercial property, 27.5 if it's residential, then I'll end up with about $20,000 of depreciation a year. Not extremely exciting. $20,000 benefit, yay. Again, we're getting to deduct something on a property that's probably appreciating in value, but can we do better than that? And the answer is yes. If we were to, in fact, on this particular property, get a cost segregation study, and that cost segregation study revealed that as part of that $1 million purchase price, we actually purchased about 30% of non-structural components. And to give you an idea of what that might be, we're talking about parking lot, landscaping, decorative lighting, furnitures and fixtures that are not, beyond just the normal bare bones type of fixtures, lighting and electrical and plumbing that services components of the building, the non-structural components like washer, dryer, machinery and equipment. I mean, what the cost segregation professionals do is they actually can take a percentage load of that wiring, which is, you know, inherently a structural component, and argue successfully that it gets a shorter life. So a 30% allocation of a purchase price to, say, a commercial property is a fairly conservative allocation. Again, it's very facts and circumstances driven, but let's just go with 30% as being a conservative number. In that scenario, you would then be able to take 100% of the allocation to the non-structural components, which in my example is $300,000. You just increased your first year depreciation deduction by over $300,000. Again, to remind you, we had 20,000 without a cost seg, 312,000 with the cost seg. Now notice that we are dipping into our future depreciation, aren't we? If we hadn't done a cost segregation study, we'd be depreciating this over 39 years, getting $20,000 a year. If we're accelerating 30% of those deductions, we're getting it in the first year at the expense of reducing our depreciation deduction in the future. I think that's a good example of what I try to tell my clients. You're not getting more deductions than you're entitled to with a cost segregation study. You're just getting them sooner. And of course, in basic investment theory, if I can accelerate deductions, you know, from a time value of money perspective, that's more valuable than getting that deduction in the future. Okay. So, and by the way, so the last thing I want to say about cost segregation study is that if you are anticipating purchasing property, you might want to do that quickly. You know, economics obviously considered, but this could be at risk. In other words, the depreciation, bonus depreciation deduction could likely be either curtailed or eliminated completely, again, as a revenue raiser. So nothing pending right now, but I would say that you would want to get those purchases in within the next 3 to 6 months before legislation gets passed. I often get asked, can legislation that's introduced be made retroactive back to the beginning of 2021? And the technical answer is, yes, it can. Practically speaking, they can't, but constitutionally, they can. I say practically speaking because I think it would cause a firestorm of resistance. But there are situations in the history where they've either prorated increases in rates or phased in during a particular year a law change. So yes, it is possible to make it retroactive. So don't take that chance. One little caveat on qualified improvement property, since it relates to depreciation. So in the TCJA, again, to enhance the bonus depreciation rules, Congress had intended for qualified improvement property, that's property that is basically done interior improvements to commercial property that is leased out to tenants, treating that as 15-year property and thus qualifying it for bonus depreciation. However, Congress failed to indicate that QIP property was in fact 15 years, and they did require technical corrections to fix that. So my point of bringing up this slide is that if in 2018 or 19 you had QIP property and failed to take bonus depreciation on it, there are provisions that allow you to go back, file an amended return, or claim the deduction actually as an additional deduction on your 2020 return with some special provisions. So I talked about cost segregation and some other ways in which, you know, your taxable income as a real estate owner can be reduced. You know, the benefits of cost segregation study as I mentioned, could be so huge that the deduction could exceed your income from that activity for the year. For instance, remember I said that we could generate a $300,000 deduction for the purchase of $1 million piece of property. Well, it's likely that that $300,000 would exceed the taxable income from that property. Is that a bad thing? Well, it depends. If the general rule, and that's what this slide is intended to show, that if we generated a loss from that rental activity and we had no other source of income against which we could offset that deduction, then it would make little or no sense, little or no sense for us to accelerate that depreciation and take that deduction. It wouldn't be worth anything to us. However, if we do have other income that we can use to offset that activity, and that other income is qualified, then it makes sense. The general rule with respect to rental real estate is that that's a passive activity. So if I were to generate let's just use an example, $300,000 loss because of bonus depreciation, do I get to use that $300,000 loss against my other income? Well, certainly if you had other rental income, passive income, yes, you would. But the other exception is if you are considered a real estate professional. So as a real estate professional, any losses that are generated from your rental real estate activities, again, my example, $300,000, are available to offset your other trade or business income, or better yet, your other passive income, dividends, interest, W-2 wages. So again, this designation can greatly enhance the deductions that you're getting because of depreciation cost segregation. What does it take to be a real estate professional? Well, the slide is here. I won't go into all the detail, but generally speaking, you have to spend more than 50% of personal service activity. That means everything that you do during the year to generate income or otherwise must be from real estate related transactions, real estate related activities, and that must total more than 750 hours. What kinds of activities count for purposes of this? Well, certainly the management and the oversight of rental real estate activities. I'm talking to the property manager. I'm negotiating leases with tenants. I'm talking to tenants. Repairs and maintenance, those type of things. Activities that don't count necessarily are, investigations of other real estate investments. So investment related activities, no, but certainly day-to-day operations, yes. And you might say to yourself, well, gee, can I really prove 750 hours in one particular property? I may only spend a couple of days a week on that property. Well, the good news is it's not necessarily property by property. By election, you can group all of your properties and all of your activities together such that you can count all those hours in one group and get to the 750. And I think that's what that slide there determines. So and one final thing I want to say about real estate professional, just because you are a real estate professional in one year doesn't necessarily mean you are one in the next year. Or conversely, just because you weren't one this year, you could possibly be one next year. So it's an annual calculation. You must keep some logs. You must, in other words, keep a contemporaneous diary of what your hours are. And so that on audit, you can prove this. But, accumulate your emails, phone records, those type of things, even maybe keep a diary. And of course, California does not conform to this, unfortunately. So you will be a passive activity. That $300,000 loss that I referred to earlier would just sit waiting for passive income. from a California perspective. A couple of things on the slide here regarding what material participation means in a real estate activity. So I want to jump to two more important aspects of what I think the changes in the law will do to our planning. And this one, A1, number one priority. So estate planning implications, as I mentioned earlier, everyone has the ability today to give away 11,700,000, which would be over 23 million in assets, either during life or at death, to their heirs, without being subject to a 40% estate tax. That exemption amount is set to expire in 2026. Is set to be readjusted in 2026 back down to its pre-TCJA designation, which was $5 million adjusted for inflation. And Biden has indicated that he would like to reduce that even further to 3.5. So, so the opportunity here is twofold. One, you should be doing planning to utilize the 11,700,000 today, regardless of what Biden does, because that is statutorily set to expire in 2026. And then that is enhanced by the fact that Biden wants to reduce that 5 million even further. Let me give you an example. So again, and you know, estate tax fairly complicated, depending on if you've given gifts, if you, you know, were your husband predeceased you, set up trusts for your benefit, for your kids' benefit. So I'm trying to make this as simple as possible. So let's just take mom, who, you know, husband has been gone a long, long time. She has $12 million in assets. She's going to leave everything to her daughter on her death. And let's just assume that she dies January 1, 2026, which is the expiration or the reticking of the unified credit amount down to 5 million. Of course, based on inflation rate, at 5 million would be about 5.49 million. So if mom were to do no planning whatsoever, and there was no appreciation in her estate, her estate would be looking at about a $2.6 million estate. So again, that's simple math, $12 million minus the 5.49 predicted to be in 2026 times 40%. Can you do better than that? Well, yes. So under the current unified credit amount, if mom were to give away 11.7 million in 2021, now I know what you're saying. Okay, why would mom want to do that today? She needs something to live on. I'm just trying to illustrate a point. Somewhere in between is the right answer. But the extreme case could certainly be mom gives away today $11.7 million. That is outside of her estate. If she died in 2026, the only remaining assets would be the 300,000, again, assuming no appreciation, and her estate tax would be $120,000. A significant reduction of the 2.6 in the other. Again, extreme case to illustrate a point. Somewhere in between is the right answer. But doing nothing will absolutely guarantee a higher estate tax. So there are several techniques, obviously beyond the scope of this presentation, that can actually assist in this type of planning. I would encourage you to look into those. All right.
We have a question that came through.
Sure.
Can one gift an IRA before one passes?
Can one gift an IRA?
Correct.
So an IRA cannot be gifted. Basically, the way you transfer an IRA ownership is through beneficiary designation. So IRAs and other qualified plans are kind of these unique animals in that they're actually considered to be what's called income in respect of a decedent. So it's as if this is income that the decedent should have received while they were alive, and had they received it, they would have paid ordinary income taxes on it. So it's an asset, it's income to be received in the future. When an individual dies with an IRA, their beneficiaries to that account step into their shoes, which means that when they draw on the account, they will pay ordinary income tax, just like the decedent would have. So you don't have the ability to gift away the right to income, I guess is the easiest way to put this. So the answer is no. You can designate a beneficiary, but you can't and take advantage of this by saying, well, I'll give it away now and therefore it won't be included in my estate. No, it doesn't work that way. You have the right to receive the income. Does that make sense? Hopefully. Any other questions on that?
Nothing that came through.
Okay. All right, so lastly, and then I want to open up for questions in general, is where do we see 1031 going? So as you all know, in 2017, they changed the rules, limited it to just real estate alone. That caused some complications because the IRS had actually not even finalized regulations on what was the definition of real property. They have now since done that. So there's a state law designation primarily with respect to what is qualified property for a 1031 exchange. But the real case here is, are they going to eliminate 1031 exchange in its entirety? There is an overarching theory of tax law that says that it is bad tax policy to tax somebody on a gain for which they do not have the wherewithal to pay the tax, or tax them on anything where they don't have the wherewithal to pay the tax. So for example, if I sell property and I take back a note from the buyer, if I sell a piece of property for $1 million, I have an $800,000 gain. I take back a note for $1 million, and let's just say I don't receive any down payment on that note. Well, but for certain provisions of the code, I would have to pay tax on that $800,000 gain in the year I sold the property, regardless of whether I collected any cash or not. Fortunately, we have some rules, they're called the installment sale rules under section 483, that allow us to defer the payment of that tax as we collect the principal. Okay, makes sense. Why do they allow us to do that? Because I don't have any cash to pay the tax on the 800. So it makes sense for Congress to say, as you collect that, Mr. Taxpayer or Mrs. Taxpayer, we would like our money, please. Thank you. It is no different in the 1031 world, in my mind. Okay, and there's other exceptions. 1033, the casualty loss rules, reinvestment of insurance proceeds. So there's a lot in the tax law that allows us to defer payment when we have the cash. So clearly, in a 1031 context, if I buy roll all my equity into another piece of property and do not put any cash in my pocket, which is the basic tenet of 1031 exchange, as long as I don't put any cash in my pocket, or if I don't decrease my liabilities, thereby improving my economic status, I don't have a taxable gain. Okay, so I think it's because of this tenet, quite honestly, one of the reasons that 1031s won't go away completely for real estate investment. The other one is clearly to the lobby, the real estate lobby. And I give I love this quote. Actually, I got this quote from Mary Cunningham, who was president of Chicago Deferred Exchange. And she said, while the policy piece was crafted and put out prior to the start of the pandemic, we are concerned no bad idea in Washington ever goes away. And that's true. So Mary actually is part of several trade associations that are pushing to retain 1031. These studies are available on the internet if you'd like to see them. And more importantly, if you would like to be part of the grassroots campaign to keep 1031 alive, there's certainly lots of forms by which you can do that. Bottom line, again, with my similar observation with cost segregation and bonus depreciation, excuse me, don't wait. If you are anticipating the purchase of property or the sale of property, and you are thinking that you want to qualify this for a 1031, you might want to get on the bandwagon sooner rather than later. Again, economics making sense. I've always said the one challenge with 1031 exchanges is that because of the timing, the 45 days to identify and the 180 days to transfer, because of that timing, you are forced to be a buyer in a seller's market. So you've decided that it's time to sell, but if you want to defer the gain, you also then have to buy, and it may not be a good time to buy. So again, run the numbers. I've said this before. You can analyze whether or not doing a 1031 exchange actually makes sense from an after-tax cash flow standpoint, especially when you combine the benefits of a purchase of the replacement property and a cost segregation study, right? You might have a situation where you could actually almost eliminate, depending on what you buy, the gain that was generated from the sale of the relinquished property. So anyway, I think that's it for my presentation. I'm happy to entertain any questions. Thank you for listening to my ranting and ravings. And Jennifer, do we have any questions?
Nothing that I'm seeing coming through. So we may give them just a couple minutes to see if anything pops through, or if somebody would like to raise their hand using the little raise a hand icon in the participants box. We can take live questions if somebody would like.
That's either good or bad. I'm not sure which.
You answered everything.
I doubt that. I doubt that.
All right. Well,
Well, maybe it would be a good time to announce our next real estate series.
Yes, we will have another real estate webinar coming up next month on April 22nd. We are still finalizing all of the details of what we will be presenting that particular episode. So stay tuned, check your email box, and we will let you folks know. Oh, we do have something that just came through.
Oh, good.
You mentioned
live bodies out there.
You mentioned at the beginning that Biden is thinking of getting rid of the step-up basis. Could you please discuss what you have heard?
Oh, yes. So I thank you for that. And I forgot to actually mention that in my presentation. But so let me just go back to the example that I showed, the simple example for estate planning with and without. So notice that without the planning, I said that the daughter in this case would receive, $12 million worth of property at that stepped up basis, but the estate would be paying $2.6 million. With planning, if we were to give that away, that would not be included in the estate. We would save over $2 million, $2.3 million in taxes, but now the daughter has just a carryover basis. So that's what the question is addressing. What I have heard is, again, this goes back to bad tax policy. So think in terms of, so the reason that we have this rule, quite honestly, was it is almost impossible to know what Uncle George or Aunt Jill or, Grandpa Jones, what was his basis in that Bank of America stock that he bought 45 years ago that I now inherited from him. That's the practical problem. So from a tax policy, it doesn't make sense. It makes more sense to give you a fresh start with respect to tax basis. Now, what I suspect, and again, this is just the world according to me, what I think Congress doesn't like, and maybe the Biden administration doesn't like, is that in this situation where property was transferred and no estate tax was paid, see, there's nothing in my example here, there was nothing that said that you had to actually pay tax in order to get the $12 million step up. In fact, in this case, they did, all right? But what if it was 5 million and it was a 5 million exemption and we were below the 5 million, you'd still get the stepped up basis. So my point is, it is likely to be that they will curtail the step up basis with respect to those estates that are not taxable. Seems to make sense to me there. I haven't heard anything specific, but that's the only way that I think it makes sense. Otherwise, you clearly are being double taxed. You're being taxed at 40% at the estate level, and then your heirs are being taxed again at maybe a capital gain rate. So I hope that answers the question. Any questions? Please send them over. We'll attempt to respond, and look forward to seeing you next month. Thanks and have a good day.